Alright guys, welcome to the first of my trading tutorial videos. My name is Chris, for any of you guys who don't know, and this will be the basics of trading. It will tell just how to read a chart, all the different components of a chart, different terms about trading, just the very basics that you can get. A lot of you guys will already know most or all of this. Some of you guys won't know any, so it'll be good. And in about 2 weeks, I'll release another one, and it'll just be more advanced, and we'll just keep getting more advanced and advanced. And hopefully, in about 2 or 3 months, I'll have released enough information for some of you guys to start demo trading, which is what I recommend before cash trading. It's nice to get used to trading. Just like anything, you want to practice before you play. So that's basically what that is. You don't want to just dive in with $5,000 and then boom, you lose, and you could have been the world's greatest trader, but because you lost your first 5,000, you're discouraged and you're not going to do it again. So that's my recommendation, is starting with demo account. It's just play money, just fake money basically, just to help you get comfortable with trading. Me and Ty are also releasing a podcast, website slash a lot of things very soon. So definitely stay tuned for that. That'll be awesome. I can't wait for that. It's just going to be a place where we can talk about anything crypto related, anything Forex, stocks related, anything trading related. It's going to be mostly geared towards cryptocurrency, but we'll kind of throw a little bit of everything in there, and we'll make sure to have a couple good guests on there just to keep some things interesting. And so yeah, so I'm very excited for that. I'm excited for these videos as well, and hopefully I can teach somebody enough and they become the world's greatest trader. Who knows? That might happen. So yeah, so let's get right to it. So right here you see we have a chart, obviously. This is Bitcoin USD on BitMEX. So this is, first let me say, this is TradingView. It's an amazing website. They do have a free version, but I have the pro version that you pay. I think I paid $29 a month. It just gives you a lot more access to the website. You can add, I think you can add up to 5 indicators, which I usually don't even use that many, but it's just, there's a couple things that I got it for, and I can't remember why, but the free version is good to follow along. It's good to start. It's good for demos, and then once you really start getting into reading charts and everything, you'll definitely want to upgrade to the pro. I think there's one level above me, which I don't know what it does. I probably knew what it did and didn't want to get it for a reason, so I stuck with this one. So this is TradingView. Over here you got your watch list, and you can add symbols, so you can add like anything really. Just do SPY, it'll be right here, anything. So I got all my symbols. I've arranged them in my Forex right here at the top. I got my cryptocurrencies that I like to trade right in the middle, and I got got gold, and then I got, these need to be moved up, and I got my stocks at the bottom. And I like them arranged like that just because they're easy to find. I also have little flags that show me the ones that I'm very interested in. You can see Disney, they've been going nuts lately. Just, I think it's from the Avengers, and just they're a good company overall. You got Bank of America, and then NEO, which is actually a electric car company. You guys want to keep a watch on this one. I'm very interested in that, and so is Apple. So can't be a bad thing, right? All right, so let's go to the Bitcoin USD chart and see what we got. So first, the basic rule of trading is you want to buy low, sell high, of course. That's the very basic if you were just buying shares and selling them, or buying an asset and selling it. You want to buy low, sell high. If you get into shorting, then you want to sell high and then buy low, which basically means you're saying from this point the price is going to go down. And so you're basically buying the rights to buy shares at the bottom, if that makes sense. So say you want to short Bitcoin up here. If you short it at 56.50, that means you're saying from there it's going to go down, and you're essentially buying the rights to buy them at a lower price. And so if you buy it at 56.50 and you decide to close your position at 51.50, then your little profit margin will be 500, and your profit will be dependent on your position size. So that's the basics of trading. Obviously, buy low, sell high. You want to make some money. The basic parts of a chart, just like any chart in school that you learn, you got your X and Y axis. Usually your Y axis is on the right side instead of the left, like in school. So the right side is almost always the price. I don't know why it would be something different, but it's going to be the price. And then the bottom is going to be your dates, dependent on your time frame, which you see on TradingView. You change your time frame over here. So 1 day basically means each candle is 1 day time span. And each 1 day candle closes at 8 p.m. Eastern time. And so I'm in Hawaii Standard Time, so that is 2 a.m. for me. 8 a.m. for most of you guys on the East Coast. Hourly candles close, of course, every hour. 4-hour candles close, of course, every 4 hours after 8 p.m. So every candle closes at 8 p.m. So you can just go from there to kind of gauge when you think it'll close. And on TradingView, it also shows you the time until the current candle closes. So this one's got 3 hours and 29 minutes left until it closes. So that's that. Let me see. So the two main parts of this chart are, all right, I'm going to stop messing around with it so much. Sorry about that, guys. I get a little ADD and carried away. All right, so the two main parts of a chart are basically the assets price, the X and Y axis, so the price and the date, and the candlesticks. So these things right here are called candlesticks. This filled in part is called the body of the candlestick, and these little lines above and below it are called the wicks, and some people call them the shadows. I actually just recently heard that. I've been trading for about 3 years, and I just recently heard it called that about a month ago. So if you ever hear shadows, then that's what it's called, or that's the same thing as the wick. And so basically what that is that's the open and close. It shows you the open and close price and where the price has been in that time frame. So let's take this candle for example. We have this candle, and you got your 1 day time frame up here. So you know this candle is 1 day, and so since it's a green candle, that means the candle opened at the bottom where this line, the bottom of the body is, and it closed at the top of this body. So that's the closing price. The closing price was above the opening price on this candle, which makes it green. Now these wicks just show you where the price has been within that time frame. So sometime within this daily candle, the price got down to about 51.71, and then sometime within this within this daily candle, the price got to about 55.25. So as you can see, this is a big daily candle, especially like this last one. Very volatile day. I actually remember this red candle right here. That was when it crashed from about 5,500 all the way down. Some exchanges it hit 4,900, went pretty low. So that's the basics of reading a candle. It's pretty simple. Just like the green one, the red one is just the opposite. So the opening price is the top of the body, and the closing price is the bottom of the body. So it closed lower price than it opened. So that means it's a red day, means obviously the asset lost value. Hence red. Red is bad, green is good if you're buying. Red is good if you're shorting, of course. So basically, the whole time that you are analyzing a chart or you are reading where price is going to go, predicting where price is going to go, this is called TA. So that stands for technical analysis. And it's basically just analyzing a chart and making price predictions based on your indicators, formations, price action, all that good stuff. And so that's called TA. So the other side of that is called FA, which is fundamental analysis. And that basically makes price predictions and price movement predictions based on, a lot of times it's news, earnings reports if you're trading stocks. It's fundamentals, like if they're about to go into a bunch of debt, like when Netflix, they spent a bunch of money going into Netflix originals and their stock just plummeted. But that's because they went into a mountain of debt. And then that was in 2017 or 2016, I believe. And then right after that, a few months later, they hit all-time highs because their subscriber count went up. So that's fundamental analysis. They brought in a bunch of money from all those Netflix originals like Black Mirror and stuff like that. So that's basically fundamental analysis, is news, events, the fundamentals of a asset. So what I mostly do is I mostly trade off TA. I keep it simple. I do trade off a little bit of fundamental analysis. You can't ignore news because it affects it a lot, especially with long-term ones. That's why I say to watch NEO. Apparently they're in talks with Apple of having a partnership because they are an electric car company. So we'll see where that goes. But so back to learning how to trade. All right. So a lot of people, depending on if you trade, right now I trade cryptocurrencies for the most part. A little bit of Forex. I'm still getting into that. The markets move a little bit differently. Well, all the markets move differently compared to the others. So I'm getting into a little bit of that, but I mostly do cryptocurrency and stocks. I would say about 70% cryptocurrency, 20% stocks, 10% Forex. So depending on what you trade, if you are going to mainly trade cryptocurrency, you won't ever see what people call gaps, which are just gaps in the chart from the price, because cryptocurrency trades 24/7. You will, however, see it in Forex and stocks, because Forex trades Monday or Sunday. Most exchange, it depends on your exchange, but most exchanges trade Sunday at 5 p.m. Eastern time all the way up until Friday 5 p.m. Eastern time. So you take Friday from 5 p.m. and on to Sunday 5 p.m. on. That's your off time. You're not trading then if you're trading Forex. And I actually don't know if Forex even has gaps, just because you can't really, like, you can still trade it, of course, at a bank, which is not practical. So I'm guessing they don't really have gaps. Now that I think about it, I never really noticed them. But if you are trading a lot in stocks, you will want to know what a gap is. And a gap is basically, since stocks only trade 9 to 5, or not 9 to 5, I'm sorry, 9:30 to 4 Eastern time, there will be gaps in the chart, because TradingView doesn't take into account after hours and pre-market trading, which pre-market is 30 minutes before and after hours is 2 hours after the market closes. It doesn't take that into account. So we got, for example, right here, this is Aurora Cannabis, a good weed stock, I would say, to have some long-term investing in. I actually made a great trade off of it on my Twitter the other day. But so you got your red candle here. So it opened up here, closed down here. This is the daily. Let's see. Yeah, this is the daily. So you see this big gap right here, not necessarily big, but there's a gap right here. That just means, so the price closed at 887 this day, and then the next day, because of after hours and pre-market, it opened at 878. So it opened 10 cents less. So this is a gap, and that will be important when you're looking at candlestick formations, which kind of indicate where price is going, bearish or bullish, and it'll also be important when you're hearing. It's a good term to know, just the gaps, because a lot of stocks will do what they say is called shoot the gap, and basically what that is it fills a gap that it's previously filled before. So it's TA looking at historic price action and seeing how it's going to react in the future. So that's the basics of charts. You got your X and Y axis. I'll take this away for now. You got your X and Y axis. You got your candlesticks. You know what gaps are if you're going to be trading stocks. That's basically about it for the basics of the chart. As you can see up here, it'll tell you the name, it'll tell you the time frame, and it'll tell you the exchange that you're charting it on. Bitcoin, of course, is traded on many different exchanges. So I like this one I have for Coinbase. This one I have for Bitfinex, and I know I have, and then this one I have for BitMEX. So just because each exchange could be a few dollars off, just dependent. So it's nice to have everything. So you got that. So those are the basics of the chart. Pretty easy, simple. Oh, also you can change your time zone on here. Mine's at New York just because I know, even though I live in Hawaii, mine's in New York just because it's easier for me. I'm just used to it. I just like it better. So it doesn't really matter. That's all preference. Okay, so now let's get into a few trading terms. The first that I want to, or the first two, is just very simple, bullish and bearish. Bullish just means you think the stock price is going to go up. So if you hear someone say I'm bullish on XYZ stock, they believe the price will go up in the future. If you hear someone say I'm bearish, then that means they think it's going to go down. So bullish and bearish, of course, bulls and bears, they're always in a clash. It's always the fight between going up and going down in stocks and crypto and stuff. So those are the two main basic trading terms. There's hundreds and hundreds. I'm just going to cover the basics for now, and then as we get into a little bit more advanced sessions, then I will start to talk about the more advanced terms. But this is just what you need to know to read a chart, to look at a chart, just to understand why a price is moving and how it's moving. So if you're going to be trading stocks a lot, you'll also probably eventually dabble into some stock options, which is basically you're predicting whether the price is going to go up or down in a certain period of time. So for example, you can buy a stock option that, say you're on, let's go to a stock, say you're on Bank of America, and I actually have one of these stock options. So say you're on Bank of America, they have tons of options dependent on where you think the price is going to go. So you have on an option, you have your strike price, and you have like the price of the actual option. Honestly, I'm not going to get into options yet because they are very complicated to trade, and you shouldn't trade them without knowing what the Greeks are, and the Greeks is a lot to explain, and it's not for this video. But just know that stock options are basically longing and shorting stocks. You're saying that you think it's going to go up to this certain price within this time period. Long and short, of course. Long goes with bullish. If you're long, that means you think it's going to go up. If you're short, it goes with bearish. That means you think it's going to go down. Same as call and a put. If it's a call option, that means you believe it's going to go up. That means you're longing it. If it's a put option, That means you're shorting it and you believe it's going to go down. A couple more basic trading terms are probably resistance and support levels, which basically is just resistance is historical lines where price has tended to stay under or get rejected at. So as you can see right here, the local resistance is, as you can see, it's been rejected about 1, 2, 3, 4, 5, 6, 7, 8, 9 times. It's right at 30, 20, 30, 15. So that is a big resistance area. And then support is where price has been bouncing off of. So it's like it's acting as support. It holds it up. So you can see kind of like over here, there's kind of a support right here around 28.90. So each time it's hit that price, it's bounced up, came back, did it again, bounced up, came back, did it again. Then once it finally broke, it went down even more. So that's how you kind of, a lot of people trade off, well, every trader trades off support and resistance. It's very big, so that's something you definitely need to know. All right, so along with support and resistance comes, so that's horizontal support and resistance. There's also diagonal support and resistance, which is just another good way to predict price based on historical movements. So right here, we got Bitcoin USD. And if you draw this little diagonal line from the big run up it had, you can see prices historically gone up, down, bounced on it, didn't go below it, gone up, down, wicked below it, which doesn't mean much. You want to look at candle closes, just because, especially in crypto, just because of like standing orders. I'll get into that later, but so historically it's bounced off this support line right here, and ideally if this candle would have closed down here or this candle would have closed down here, it would have kind of invalidated the support. So any room to run down here and go a little bit lower is fair game. But since it didn't, it's kind of staying right around here, and it could just bounce again. So that's horizontal, or not horizontal, diagonal support. And then of course diagonal resistance is just the same. A lot of times if you draw stuff like that, it will form channels, and I'll just show you like a trading channel. One trading channel I had April 1st before this big pop, I saw this and I drew this little channel just because it was so tight. It hadn't moved for days on days. And so I was like, all right, let me draw this little channel just to look. And so essentially what I was doing was I was trading based on this channel. If it broke out right here, I had buys at 41. It's a little bit easier to see on lower time frame, or a little bit more accurate. But I had prices or buys at like 41.90 or something to open along, and then I had sells like right below the channel, and so that netted me some good. Just trading off that channel was a pretty good trade. So channels is a price action formation, which we'll get into a lot probably in the next videos. I think that about wraps it up for this part of the first series. That's basically the basics of trading, what you need to know. You need to know what's on a graph, how to read it, everything on it. You need to know the candlesticks, what they do, all the terms I told you guys. And of course, if there's any terms that I didn't cover, I only covered a few, but if there's any terms I didn't cover, just send me an email and I'll easily explain it, or you can Google it, of course. But those are just the terms that were used in the video, and of course I'll explain more as we go along. Next videos will probably be about price action formations and indicators, and what they do, and candle formation as well. So basically identifying the components that tell you where price could go based on historical points. And all right, guys, so that's basically the end of this video. Like I said, there will be a lot more information to come, probably next week, honestly. This actually took a little bit less time than I thought it would, so I'll be able to pump out a little bit more content for you guys a lot quicker. But if you have any questions, feel free to email me. If there are questions that aren't related to the video, try to keep them down, just because eventually they will be answered through other videos. And if the time comes and I cover the subject but still haven't answered your question, then I will be happy to answer any questions. But until then, I'll see you guys in about a week, and safe trading.